Professional Traders. Courses of the Professional Trading Master. Master 2019. Course 2. Psychology in the Trading Process. Welcome to the course. Welcome to this Master of Professional Trading. This Master is composed of 20 professional trading courses, aimed at new traders. Presentation of the course. Undoubtedly, one of the last steps in the evolution of all trader, is to be able to reach an adequate mental state, for the correct execution of operations in the market. The fusion of knowledge, and emotional control or psychological control in the brain of the trader, makes it reach the state of consistency. Just as a building must have a solid foundation, we must create a solid psychological foundation to be consistent traders. In the mind of any human being a duality coexists, fiction and reality. The degree to which one dominates the other in our mind, is what makes each trader see the market from a different perspective. If we are not consistent traders, the fiction dominated by emotions will make us an easy prey for the consistent traders when we face them in the market. In order to be a consistent trader, it is essential to know how we have to act at all times, and to know the mental traps that our emotions generate, since otherwise, our decisions will undoubtedly damage our results. Only through an adequate learning of the psychological control, we will acquire an appropriate mentality, to obtain consistent results. Consistency is a state in which the trader achieves a prolonged time, that the balance of its winning operations against the losing operations is always positive, in any market and in any time frame. This course is of vital importance for your training as a consistent professional trader. Individual Psychology. Individual psychology is a psychological theory devised by Alfred Adler. Unlike Freud, Adler believed that man has possibilities to improve himself and progress in the life, to reduce his problems and eventually to reach an almost perfect adjustment of his life process. Individual psychology does not treat a symptom or an isolated expression, it seeks to discover the mistake made in the whole lifestyle, in the way in which the mind has interpreted its experiences, in the meaning it has given to life, and the reactions with which has responded to the actions received by its human body, and the environment that surrounds it. Individual psychology poses life as a struggle from birth to death, a kind of journey in which each human being uses his own method of subsistence, in which each traveler interacts with others, in which each one is driven by many goals common to other individuals, and in which all are equally exposed to the vicissitudes of the itinerary. Individual psychology describes human behavior through 7 principles. 1. Inferiority. 2. Superiority. 3. Lifestyle. 4. I create. 5. I conscious. 6. Fantastical goals. 7. Social interest. In the course book, each of these principles is developed in depth and explained how they affect our trading process. Study these concepts in depth, as they will allow you to improve without doubt your trading process. As a summary of all of the above, we can point out that our individual psychology can lead to success or failure in the trading process. And as proof of that, we are going to analyze in the next article the psychological cycle of an inconsistent trader and a consistent trader. Psychological cycle of an inconsistent trader. All traders prepare their trading day before the opening of the market. Each one performs his preparation in a different way. The consistent traders review their rules of entry and exit, analyze the previous session establishing the entry and exit levels of the market, and review their trading plan. The inconsistent traders simply wait for the market to be open. They do not prepare for the session. They do not have a trading plan, nor do they have specific objectives. Let's see how both types of traders operate through the following example. Let's suppose that the market in the stock selected by 2 traders, one consistent and the other inconsistent, evolves in the way represented in the attached graph. And suppose that the inconsistent trader opens a position in the instant that we have represented in the graph with the value of time t1. The consistent trader, after an analysis of its entry rules, has opened its position at the instant that we have represented in the graph with the value of time t2. In the period between time t1 and t2, the price has moved down to a support level position. In the inconsistent trader, by not controlling his emotions, the feeling of disbelief begins to appear. He thinks that, as usual, he has been confused. He does not take measures to close his operation if the movement falls below the support level line. In the next period between time t2 and t3, a range of emotions appear in the inconsistent trader, ranging from hope that makes him think that the price is likely to recover and go in the direction of his operation, passing through optimism, which announces that the rally is real, up to the belief, which is when, based on his emotions, he decides to increase his investment without controlling the level of risk that implies. In the consistent trader, emotions do not appear. He knows that his prognosis was true, and he carefully monitors his operation. He does not increase the level of risk. The next period between time t3 and t4 is the period of the loss of the reality of the inconsistent trader. New emotions appear, such as lack of control, which forces him to further increase his investment, placing his level of risk at irrecoverable levels in the face of any sudden change in trend. Euphoria appears, which makes him think that the trading has no secrets for him, is a genius, and will become a millionaire in a short time period. However, for the consistent trader, the time has come to close its operation. He has already obtained the benefits set in his trading plan, and the price has touched an important resistance level line. In the period between time t4 and t5, the price trend changes. The inconsistent trader changes its feeling of euphoria for the one of complacency. He is convinced that the moment that the price raises again, he will close it. However, what he does not know is that his emotional control is null, and he is not able to close his operation. The greed clouds his sight. He does not settle for the profit that he has at this moment, and he is not condescending with the market. Unfortunately, the price continues to fall until the next support level line. At this moment the anxiety appears, and it makes he think that the price will rebound in the support line, and it will go back up, and with the money that he has won until now, it is not worth for closing the operation. He is not able to understand that his level of risk does not allow him more mistakes. On the contrary, the consistent trader has opened a sell operation at time t4, and watches it carefully. If the price does not break the support level line, he will immediately close the operation. In the next period between time t5 and t6, the price sharply drills the support level line. In the inconsistent trader, emotions are triggered uncontrollably. Anxiety gives weight to unbelief, and blame for their mistakes to the mass. Think that as everybody said that the trend of the price it would change, and the price it was going to rise, it was impossible to predict what is happening now. He is unable to see the direction of the trend. Next, the panic appears, and a flash of reality makes he see that if the market keeps going down, he will lose all his money due to the excessive risk acquired. But the lack of emotional control prevents him from reacting and is unable to close his operations. He remains hypnotized, looking at the screen, waiting for a miracle to occur. The price keeps falling, and in the inconsistent trader the capitulation appears. It is aware that it is out of the market. He has lost its investment. He has nothing left to continue operating another day. The anger appears. He cannot believe what has happened to him, and he charges his anger against the market, the government, etc., less against the true guilty, himself. Only he is responsible for his actions. The consistent trader has closed its sell operation. He has already obtained the benefits set in his trading plan, and the price has touched an important support level line. From this moment on, two antagonistic emotions follow one to another, which further psychologically destroy the inconsistent trader, which are, on the one hand, the depression, which abruptly returns him to reality by transmitting the message to him, that if he had closed the operation on time, he would not have lost his investment, and on the other side the distrust in the market. This sensation emerges when the movement price changes the trend, and follows the previous trend predicted by the inconsistent trader, but unfortunately, it is already too late for him. This fact makes he think that the market is manipulated and that it goes against him. For the consistent trader, it is time to wait for a new window of opportunity to occur, and its rules of entry into the market will be met. His emotions are limited to the confirmation of a job well done. Psychological cycle of a consistent trader. As we have explained previously, a consistent trader reviews its rules of entry and exit, analyzes the previous session establishing the entry and exit levels of the market, and revises its trading plan. The consistent trader only enters the market in windows of opportunity, that is, in the moments in which its trading system establishes that the probability of success is maximum. He is not a guru, he is a professional trader. Patience, tranquility, professionalism, compliance with the rules of entry and exit, and the confirmation of a job well done are its operational characteristics. He develops his work with pleasure. Emotions are outside the equation of his operational trading. And he knows and accepts that, although his trading system has a high probability, he must assume that a certain number of operations will have to close them at a loss. However, he does not worry, nor does this fact overwhelm him. When he opens an operation, and it does not evolve properly, he closes it immediately. Never let operations run at a loss. Once he has reached his daily goals, he closes the operations screen. He does not overtrade. He updates his operations diary log, incorporating graphs and explanations of why he enters in each operations, and the reasons why he closes them. Collective psychology. The trading is the fight between a mass of bullish traders and a mass of bearish traders. Each of them has previously made its particular analysis of the movement of the price. However, only one of the two sides will be the winner in a specific time frame. The collective of traders is subdivided into two sub-collectivities, one bullish and one bearish. Each of them antagonistic, but with the same actions and reactions. In these sub-collectivities the individual requirements are erased, thus disappearing the personality of each one of the traders that integrate it. The unconscious emerges in the first place, and the heterogeneous merges into the homogeneous. The psychology and the emotional control, so diversely developed in each trader, are diluted, appearing an unconscious common base in all of them. In this way, a medium character of the traders formed in multitude in sub-collectivity is formed, and at the same time new qualities appear, of which they lacked before individually. Because of all this, we can never and under no circumstances allow our emotions to sabotage our trading process. And for that, we are going to use the knowledge that the tools of psycho-trading provide us. Psycho-trading and trading plan. The psycho-trading is a specialization of psychology, which analyzes, identifies, and trains the behavior of the traders in front of the market. As with psychology, two different specialties can be established within the psycho-trading. 1. Individual psycho-trading. Its objective is to analyze the psychology of the trader in order to obtain the consistency in the market. 2. Collective psycho-trading. Through the combination of economics, psychology, and neurology, the collective psycho-trading analyzes the psychological foundations of the mass of traders, on which their investment decision-making in the markets is based. In this way, everyday researchers and scientists study and reveal the reasons for the non-rational behavior of both the individual trader and the mass of traders, their effects, and how to prevent us from them. The psycho-trading is in charge of analyzing, studying, and improving the 10 knowledge areas of the trading process. 1. Trading style. 2. Selection of stocks. 3. Technical and psychological training. 4. Trading system. 5. Rules of entry and exit of the market. 6. Psychological control. 7. Risk management. 8. Benefit management. 9. Decision process. 10. Error control. A trading plan is in fact nothing less than a written document in which I establish and define the 10 areas of knowledge in a clear and concise manner. The systematic fulfillment of the trading plan allows us without a doubt to reach the consistency. Basic concepts or psychotrading. Once the concept of psychotrading has been defined, and its functionality established, we will proceed to present you the most relevant basic concepts or psychotrading, which will allow us to understand why it is so important in our life as professional traders. And for that goal, we are going to analyze the following concepts. 1. Self-evaluations, audits, and error control. 2. Negative emotional psychology. 3. Which is the great error of many traders. 4. External conditioning of the trader. 5. Value function of the trader. 6. The worst enemy of a trader. 7. Matrix of decision of a trader. 8. Trading is a business, and not a game. 9. The 7 deadly sins of a trader. Self-evaluations, audits and error control. The daily psychological self-evaluations, the operations audits and the error control, will be key elements to analyze the investment opportunities that are adequate to our capabilities. These elements will allow us to analyze and evaluate our successes and failures, and therefore, it will allow us to adapt our mind to the operative consistent in the market, through the control of our emotions. If we do not carry out these evaluations, and we trust our success to our trading system, in the information, in the analysis of the market, and we forget the psychological component, such as our emotions, our weaknesses, etc., and we finally also forget the error control component, we will fall into the trap of thinking that we control the market. And it will be impossible for us to reach the consistency, which will lead us without a doubt sooner or later to sabotage our trading plan. And on this path, we will never find the consistency. Here is the great difference of the psychological component between a winner trader and a loser trader. Negative emotional psychology. The most interesting study area, and most important within the psychotrading, for a trader, is the analysis and control of negative emotions. A consistent trader must know human behavior and how thoughts, feelings, and emotional impulses shape their behavior patterns. If we represent in a pyramidal form the fundamental elements that make up the negative emotional psychology, the negative basic emotions constitute the vertex of the pyramid. Undoubtedly, in any trading process, the negative basic emotions appear, such as fear, insecurity, impatience, or arrogance, and overconfidence. If these emotions are not controlled, the next level appears as a consequence of a loss or error, which is the level of negative emotions derived, nervousness, guilt and shame. And in turn contradictory feelings appear. As in the previous case, if we cannot control them, we are at the next level, which are the negative consolidated emotions, which are manifested through excitement, impulses of buy and sell without control, and excessive risk. The trader is no longer able to analyze the situation rationally. He wants to recover his error at all costs. He is not capable of assuming the loss. His risk level is out of control. This level unfortunately leads to greed, and finally to the sabotage of the trading plan. The lack of discipline inexorably leads to the absence of consistency, which is the big mistake of many traders. Brett Steenbarger, clinical psychologist, is one of the most successful traders in the world, as well as an expert in market psychology for more than 40 years. Author of numerous articles on psychology of the trading or psychotrading, by his hands have passed hundreds of traders to receive training. For Brett Steenbarger, the big mistake of many traders is to do trading without being prepared. Although it may seem like a lie, it is the harsh reality. Every year, millions of traders enter the market without adequate training. Trading requires many skills, such as a professional golf, football or chess player. It involves many hours of practice, study and training. But many traders forget about this, and he wants to make money quickly and start doing trading without being prepared. This type of traders is dazzled by the possibilities offered by the trading. They have not stopped to analyze the level of risk they run in each operation, how they should manage their investment, what are their entry and exit rules, etc. Although they do not know it, because they are unable to see and feel it, the reality is that their mind is dominated by fiction. External conditioning of the trader. In any profession, the professionals who develop it must face a multitude of problems that they must try to solve satisfactorily. In the same way, a trader must face a new market scenario every day. This scenario is the daily struggle between bullish and bearish. And you must face your weapons. Those weapons will give you the ability to win in the battle, or lose it. It only depends on how you apply your system, how you handle information, your risk management, and your emotional control. And all this, while the external forces interact on one side or the other. These external forces that condition us in our trading process are the following. Mass media noise. It is the noise generated in our subconscious, by relatives and friends, who think about the trading on many occasions without having knowledge of it, and who can distract our attention, and hinder the correct decision-making. The political forces. The institutions, as well as the central banks, and the governments propose measures that sometimes go against our positioning in the market. Its knowledge is essential, and the analysis of his influences. Sensational economic news. This type of information conditions thousands of traders, feeding their fiction and provoking the movement of the market in the sense desired by the generator of the news, unfortunately causing many traders to make erroneous decisions and succumb to reality. Sages and gurus of the trading. Do not think that there are magical methods. If there were those who discovered them, they would not sell them. The robots. For many years, thousands of traders have fallen into the thymus of the magic robot, which predicts the future, and which gains disproportionate profits. The reality is nowadays, far from being that way. A robot must be programmed with algorithms based on technical indicators, and a trading system. The robot executes the programming, avoids errors such as delay or precipitation, and does not allow itself to be influenced by emotions, but in the end, it is executing a system, as any trader does. Function value of the trader. Sigmund Freud is considered the father of modern psychology. Freud's ideas about basic human impulses led, among other theories, to what we now call the pleasure principle. The most interesting discovery of all the work done, to fully understand the pleasure principle, was made in 1979 by researchers Daniel Kahneman and Amos Tversky. His research, already corroborated today by many other researchers, demonstrated the prospective theory. From the direct application of the prospective theory to the trading, it is demonstrated from the empirical evidence that when we have benefits, we reduce the risk and increase the probability of gain even more. Whereas, when we are facing situations of loss, we change our mentality, and we increase the risk by drastically reducing the probability of profit. This change of mentality, that causes an increase in risk when we are losing, can be explained through what we call the trader's value function. In the attached graphs we have presented the value functions of an inconsistent trader, and a consistent trader, and how they affect our psychology in each case. The worst enemy of a trader. At the time of investing in the financial markets, all the traders we are before our worst enemy in the market, ourselves. And for this reason we must start from today to establish the necessary measures so that this fact does not happen. The trading, like any other profession, has gone professionalizing. Today there are many companies of institutional trading, that to avoid this effect, they have resorted to the figure of the controller. Each operating table is composed of two traders. The first is the trader-operator, develops the pure functions of trader and directs the operations. The other one is the trader-controller, verifies that the decisions of the trader-operator are correct. The trader-operator cannot open any operation without the consent of the trader-controller. In this way, a double check of each operation is caused. Similarly, the transactions are closed when both traders agree on their closure. Once the trading day ends, they jointly prepare the operations diary log, clearly explaining the rules by which they entered in each operation and the rules by which they close each operation. Decision matrix of a trader. The decision matrix will inform us when we can open a position in the market, when we need to close the position in the market, and how to follow the trend. We will explain now how to make the decision matrix of our trading system. This exercise of mental and emotional control must be done by the trader for each stock of the market in which he wishes to operate, and for each time frame. Let's suppose that our trading system is based on 4 rules of entry and exit, based on the signals generated by 4 technical indicators. Suppose also that we have studied and validated our trading system in a demo account previously, obtaining the individual probability percentages of each rule. Therefore, we will only enter the market in opportunity windows. An opportunity window is when a high probability case is presented in the market. No decision to operate in the market should be made against the attached table. Any decision against this decision matrix, it is considered an irrational and inconsistent behavior. The trading is a business and not a game. During the years that I have taught trading to my students, I always obliged them to deposit in a common fund that we use to pay for the master's end dinner, an amount of €10 as a penalty, each time they used the expression, play in the stock exchange market. At the end of each year, we had money to pay for a dinner for each student, in the most luxurious and expensive restaurant in Madrid. If what you want to do is play, go to a casino, they are designed for that. If what you decide you are going to do is invest in the market, then form yourself and never consider it as a game. The trading is a business. Therefore, the trading, like any other business, requires knowledge of it. Therefore, the first thing that we must do before investing in the market is to study it conscientiously. If you are not prepared technically and psychologically, do not trade. Remember that it is never too late to start your training properly. The 7 capital sins of a trader. We are going to present to you the 7 most common capital sins that a trader commits habitually. Remember, our mistakes make us strong, if they are worth not to commit them again, and make us even weaker, if we repeat them repeatedly. The 7 capital sins of a trader are as follows. First, invest without control. Invest in stocks that have shown a good evolution, without assessing in depth the context or the risks to which they are exposed. Second, simplify the market. Sometimes we tend to generalize complex situations, to understand them better, and we do not take into account the external conditions of the market. Third, illusion of control. That we can measure risk, does not mean that we can control the market. Quarter, over-optimism. We all have a certain natural tendency always to think about the positive, and to avoid thinking about the negative. Fifth, prejudice interested. It is the innate desire to interpret the data in the way that most interests us, trying to justify positions and sometimes indefensible operations. Sixth, unnecessary risk. It is the innate desire to reach high levels of benefits and profitability in a short time. Seventh, intentional fiction. Do not delve into the reasons why we make our decisions, in one way or another way, and create a fiction so as not to see what we are not interested in. Finally, if we are capable of not falling into these traps, natural in the human being, we will have more possibilities to reach the consistency in the market. Obviously, correct all these innate errors to our psychology requires effort and time. And for that reason, you should start to correct them from today, so that, when we reach to the last master course, you have already overcome them. Live from the trading. To the question, can you live from consistent trading? The answer is a resounding yes. Now we only have to establish the fundamental requirements that we must meet in order to live from trading. The fundamental requirements are the following: technical formation, psychological training, establish a high-probability trading system, establish rules of entry and exit of the market, always comply with the rules, properly manage risk, properly manage profit, manage your errors properly, achieve consistency with your trading system. In summary, master the 10 areas of knowledge of the trading process, and achieve the consistency. During the development of this master's courses we will teach you how to master all these requirements. Conclusions. The movement of the price of a stock in the market is a consequence of the decision of thousands of traders in a determined time frame. We must always operate together with the stock trend. Open operations against the trend of a stock only entails the loss of our money. Before making the decision to enter the market, we must ensure that our operation has a high probability through the decision matrix. Consistency is based on achieving, as many times as possible, follow the trend of a successful stock. And in cases where our prediction does not coincide with the tendency, make the decision immediately to close the operations. As we will see in later courses, when we study how to evaluate the consistency of a trader. It is considered basically that a trader is consistent when the percentage of maximum daily loss is less than 50% of the percentage of the average daily gain. Finally, and to conclude this section, I want to highlight the importance of psychotrading to reach consistency. Always remember, the trading is a 10% technique and a 90% psychology. Without the domain of the 10 knowledge areas of the trading process, it is not possible to acquire the consistency. Now, it depends on you. Remember, you must have patience and perspective. In the trading there are no shortcuts. You must study the course book, review and practice, over and over again the concepts that we have taught you in this course, until you master them. Remember, the course book develops in depth the topics presented in this video. Golden Rules. Based on the concepts established in this course, we can determine the following golden rules. Never operate with borrowed money. It establishes a clear and simple trading system. Do not be greedy. Always operate with the trend. Always have the trading plan with your decision matrix in front of you. It does not matter if you win or do not win in an operation. No overtrade. Keep an operations diary log up to date. If you lose the consistency, immediately stop trading. Operates always from minimum risk levels. Withdraw benefits from your trading account. Do not keep operations open for a long period. Close the operations that do not evolve properly. If you lose 2 operations consecutively, you must stop trading. The rules of the trading process are established to comply with them. Adequate training, together with the mastery of the trading process, is the step from inconsistency to consistency. Course exercises. Each course consists of 4 evaluation exercises. No question will be answered, no evaluation will be made, if the student is not correctly enrolled in the master, and if the student has not paid the exam fees. Course exercises. Exercise 1. Describe your aptitudes, attitudes, your virtues and your defects as trader when you face the market. Exercise 2. Evaluate in an Excel table each one of your aptitudes, attitudes, your virtues and your defects like trader when you face the market. Exercise 3. Describe your 7 deadly sins as trader in your trading process. Exercise 4. Describe the errors that you usually make when you do trading. Explain what actions you plan to take to avoid them. Farewell. So far the second course of the Master. Psychology in the Trading Process. This course is part of the Professional Trading Master courses, aimed at new traders, developed especially for you. I hope that the information that we have transmitted to you is of your interest. Do not hesitate to inform you about the rest of the courses on our website. I wait for you in the next video of this exciting master. Until then we wish you a happy trading.